Many people are still under the impression that they need to hire a financial advisor in order to get their finances on track. However, this is not always true. Hi, my name is Tay from Financial Tortoise. Financial advisors are often expensive and can be confusing, especially if you're not sure what they do for your money. That's why I'm going to break down for you 5 reasons why you don't need a financial advisor. Let's get started. Number 1, most financial advisors can't beat the market. Most people paid to deliver higher returns than the stock market as a whole can't do it. When we talk about the stock market, we're most often referring to what is known as the Standard & Poor's 500, or simply the S&P 500. The S&P 500 is an index of 500 largest companies on the American stock market. It includes major companies such as Apple, Google, Coca-Cola, McDonald's, including hundreds of other large to small companies. Since 1980, the S&P 500 has delivered an annual average of over 7%. So in order to beat the market, a financial advisor would need to design a portfolio that surpasses this number. This is not easy. The financial advisor must be skilled at selecting the right investments, diversifying, and keeping up with the market trends. Very few financial advisors have the skill and knowledge necessary to beat an index fund. According to a 2020 SPIVA report, over a 15-year period, nearly 90% of actively managed investment funds failed to beat the market. The majority of these actively managed funds had either poor performance and high fees or average performance and low fees, but only about 1 out of every 10 performed well on both ends. So to reiterate the reason why you don't need a financial advisor, they're expensive and don't necessarily produce better returns. Moving on to the
Okay, so I really appreciate where Tay is coming from here, but he's definitely conflating 2 completely different roles in the financial services industry. So we have financial advisors, financial planners like myself, and then there's the actively managed funds and their managers as well. These are not the same things, and we're kind of overlapping them, and that's totally wrong. So as a financial advisor, I am not trying to beat the market. I love low-cost index funds, and a lot of my clients are invested in them. I don't invest in any high-fee mutual funds or ETFs or anything like that, and I don't earn commissions or kickbacks from mutual fund or ETF companies. My job is not to outperform the market, it's to provide alpha to my clients through our financial planning services. So retirement planning in itself is a whole slew of things, a whole lot of landmines out there and mistakes and optimizations that can be made. So withdrawal strategies, Roth conversions, we take a huge look at tax planning, education savings, estate considerations. The investment management side of it is just one part of the total services that we offer, and that's where an advisor should be providing you alpha, is through those services. I would be concerned if your advisor is saying, hey, I can beat the market, because that's a silly take and that's concerning. And I would be worried you're not working with a true fiduciary, advisor, and you're working with somebody trying to sell you on something, and that's something to be worried about. But if you're working with a true fiduciary, especially a fee-only fiduciary advisor and a CFP, you aren't going to hear someone saying, we're going to beat the market. That's silly.
Second reason why you don't need a financial advisor. You pay even when financial advisors lose money. The second reason why you don't need a traditional financial advisor is because even if they manage to lose your money, which majority of them do as I stated earlier, you'll still end up paying for their expensive service. Financial advisors make money by charging you a percentage of the amount they manage for you, typically ranging from 1 to 2%. For example, let's say that you have a financial advisor managing your $100 million portfolio, and he or she charges you 1% for managing it. And let's say your portfolio lost 15% this year, $15 million. What is outrageous in this scenario is that while you lost $15 million, you would still need to pay your financial advisor the 1% management fee, $1 million, for losing you $15 million. Your advisor's strategy didn't work out well at all, yet he or she still makes money off of you while you lose.
Okay, so that is an outrageous example. So the assets under management fee is a pretty common model out there for how advisors get paid. Now, generally speaking, the average rate is more around 1%. Anything higher than 1.25% is pretty high, especially upwards of 2%. I haven't really heard of that too often anymore. But again, let's just say the average fee is around 1%. That would not be for a portfolio of $100 million. That would be way lower than that, because how these models are structured out is, say the first million you get charged 1%, then the next 2 million you get charged 0.75%, and then the next 5 million you get charged like 0.5%. I'm oversimplifying it, but that's generally how these AUM fee models are billed. So your effective rate is not going to be 1% on 100 million. Nobody is going to be paying that. But again, it comes down to, are you getting the alpha from their financial planning services to outperform whatever fee that they're charging you? And I can tell you confidently that a lot of clients do get that alpha from those financial planning services, and they're very happy to pay 0.8, 1%, or even 1.25% of their assets under management because they're getting way more in return. So again, if you just look at the performance of their portfolio, you're missing the other 90% of where the alpha should be coming from. The downside is that it's not easy to quantify that in a chart unless it's really kind of spelt out, like I mentioned in that Vanguard Advisor Alpha study, where it is kind of spelt out. But again, he's kind of conflating two things here, but I still appreciate where he's coming from because he's just trying to educate people on, not trying to get burned. And I will just say, if you're going to make the argument that your advisor can make money if your portfolio loses money, that is technically true under the AUM model. But at the same time, they're also incentivized to make you more money over time because they're getting paid a percentage, so they'll make more money. So that argument can go both ways. I've never really liked arguing that argument either way. I'd rather just focus on providing alpha to my clients where we realistically can. And then if we do charge on an AUM basis, it should be definitely beneficial and we should provide more alpha than our fee, of course.
This leads us into our third reason why you don't need a traditional financial advisor. Rather than paying for an expensive financial advisor who may not be able to outperform the market based on your goals and risk tolerance, you can invest in low-cost index funds instead, which will save you time and money. Number 3, investing in low-cost index funds will make you more money. First of all, what is an index fund? An index fund is a mutual fund that tracks the performance of an established financial benchmark, such as S&P 500 or Dow Jones Industrial Average. Index funds are passively managed, which means they don't engage in any type of market timing, and they simply buy and hold all securities included in the financial benchmark being followed by the index fund. In essence, you can bypass the intricacies of stock selection that are outside your scope or knowledge by buying a share of every public company in the market through an index fund. Most research shows that investing in index fund can lead to higher returns with lower risk over time compared to actively managed funds. Since 1990, index funds have outperformed the majority of actively managed US stock mutual funds on a total cumulative basis with lower volatility and less risk according to SPIVA scorecards. Index funds also offer protection against the risk that you'll lose money because they are a diversified portfolio, meaning that your investments will be spread out across varying sectors and industries to help balance out any potential losses in one area or another over time. What's more, and this is my favorite, index fund fees tend to be much less expensive than what many financial advisors charge for their services. I currently hold majority of my own investments in an index fund called VTSAX, a Vanguard's total stock market index fund, and it charges an expense ratio of only 0.04% compared to actively managed funds of 0.5% to 1%. This is 25 times less. The combination of this lower cost and higher returns is why it makes sense not to hire someone as an advisor, but instead invest on your own through low-cost index funds.
Okay, so I pretty much agreed with almost everything he said there until the end when he conflated the actively managed fund manager and a financial planner. Completely two different roles there. Now, again, I love low-cost index funds. I use them a ton at my firm, and I think that they're awesome. I also do like the total market low-cost index funds by Schwab, Fidelity, Vanguard, and a few other providers as well. Now, when he's saying that, should you be 100% invested in low-cost, stock market index funds, it's really going to depend on your risk tolerance, your risk capacity as well, because not everybody should be in a 100% equity portfolio if it is indeed like an S&P 500 index fund. 100% stocks can be very risky for some folks, especially if you're more focused on wealth preservation and not wealth accumulation. Now, if you're watching this and you're 21 or you're 25, maybe 30s, or even around those ages, 100 or 90% stock allocation is probably going to be just fine because you got a long time horizon. If you're in your 50s, 60s, 70s, and 80s, 100% stocks feels a lot different because when the market has a downturn and you just lost 30 to 40% of your nest egg, that doesn't feel too good. So again, very accurate in the sense that he is right about low cost index funds outperforming those, equated mutual funds, those high fee mutual funds. But then he came in at the last second and said, well, that's what a financial advisor does. No, that's the wrong part. But I like low cost index funds, so keep preaching that part.
Number 4, no one cares more about your money than you. You care about your money more than anyone else does, and it's up to you to make sure that everything is working as efficiently as possible in order for you to be successful over time. This was a harsh lesson I learned in my 20s. I've made every possible money mistakes you can think of. I've leased a car without calculating the true cost. I've carried credit card balance. I've allowed financial advisors to invest my money in investments I didn't understand. I took out unnecessary student loans. I essentially allowed consumer marketing, financial advisors, and big banks to take advantage of my naiveness and essentially make my money decisions for me. It wasn't until I was at the brink of financial catastrophe in my late 20s that I started to pay serious attention to money. I started to read every book I could get my hands on related to personal finance. It took me a while, but eventually I learned what made sense for me and began developing the personal financial knowledge necessary to make solid financial decisions without the need of an advisor or a bank steering me in one direction or another. So take responsibility for your own financial situation instead of trusting that others have your best interests at heart. Number 5.
So I do like what he's saying about you should definitely have a very, at least the very basic understanding of personal finance and your financial situation. And I think it's awesome that he sort of took the reins in his own hands and wanted to, take control of his financial future. That is really awesome. However, for a lot of people, whether it's they don't have time, they're just not interested in knowing about it, or they just realize that they don't know what they don't know, there is going to be cases where a financial advisor is going to be beneficial. And again, not all financial advisors are created equal. Like I said, not really a big fan of bank advisors. I'm not a fan of commission financial advisors, which by the way is a loose term. Financial advisor can really mean someone isn't really actually a regulated term. So it could be an insurance person saying that they're a financial advisor who's selling whole life insurance, which is not good. In my opinion, if you're going to work with a financial advisor, look for a certified financial planner. And then I also would like to work with somebody who's a fee-only financial planner. So no commissions, no kickbacks. It's a more transparent model. And then the CFP credential is robust and it's a pretty good credential to have. So again, we got to be careful kind of, saying one thing means all things regarding financial planners. But I still think it's awesome. I think and when it comes to my own clients, I feel like I try to teach them and be a teacher more than anything. And while I certainly have a lot of things that I can learn too, I always try to help my clients understand what we're doing and how it's impacting their finances. And I always try to tell them, hey, go research this on your own time. You can go double check this. You should be working with somebody who does have, as Dave Ramsey says, a heart of a teacher. And I think that is very nice to see when it comes to working with a financial advisor. But if you don't want to work with one, of course, that's fine too. And I think doing things by yourself is totally fine. But again, truly being able to compare that to working with a financial planner, that's going to be hard to equate, mathematically because there's so many factors. But there is a lot of research that shows out there that people who do work with financial planners do better over the long term, because sometimes you just don't know what you don't know, and there's nothing wrong with admitting that.
You can learn to manage your own money. I used to think that people who knew how money worked were just naturally smart. They could spew out financial jargons like hedge funds, leverage, stocks, bonds, etc., and I would have no idea what they were talking about. It was only years later I realized that they also didn't have any idea about what they were talking about either. Financial knowledge isn't a talent. It's an acquired skill, and you can develop those skills. There are plenty of resources out there to teach us how money works. Books, blogs, YouTube videos, like the one you're watching right now. Let me share with you a few of my favorite personal finance books that got me started. Dave Ramsey's A Total Money Makeover, a great book on debt paydown and money mindset overall. This book got my wife and I kickstarted on the journey to paying down our $105,000 of combined student loans. Jill Collins' The Simple Path to Wealth, the best investing book I've ever read. He distills the principle of investing down to the simplest form possible that even I could understand it. Ramit Sethi's I Will Teach You You to Be Rich. A corny title, but a great book for professional millennials. He lays out some great frameworks and systems for managing your money. The key is to get started and not be intimidated. If you have the willingness to watch this video and grow yourself, you definitely have the ability to develop a strong financial knowledge so you can start managing your own money.
Yeah, and I really don't disagree with that. I really think that if you want to take the time to learn into how to manage your own money and learning more about finance is a really great thing. There's absolutely nothing wrong with that. And actually, if you look through my channel, I'm hoping that there is a lot of good videos out here obviously for free that provides a lot of solid content from a CFP professional and from someone who's in the industry, who kind of understands how these things work, and I can try to provide the best advice I can to all of you watching. So again, thank you, Tay, for your video. I do appreciate it. Obviously, we didn't agree on everything, but I still think it's awesome that there's people putting out these videos for us to all watch for free and share our opinions on and learn something. Again, thank you guys so much for watching, and I'll catch you in the next video.